Hi guys, it's Lawrence Kobescak with Realty. Saving for a down payment can be tough. Today I want to show you how you can borrow up to 100% of your down payment from a line of credit, credit cards, bank loan, or a gifted down payment from a family member. The name of this mortgage insurance program varies, but is effectively known as the Borrowed Down Payment Program. Mortgage insurance is required in Canada for any borrower with less than 20% down. The three mortgage insurance companies available are CMHC, Genworth, and Canada Guarantee. The selection of which mortgage insurer was used is usually transparent to borrowers, as the application for mortgage insurance is made by the lender. You will need to indicate to the lender at the time of the application that you will be borrowing all or a portion of your down payment. Here are some of the criteria and restrictions of the Borrowed Down Payment Program. The program is available for new or resale properties. The maximum purchase price is $1 million. There can be no more than 2 units in the home, and one must be owner-occupied. You must have provable income. Self-declared business income is not permitted. The New to Canada program is not eligible in conjunction with this program. Sources of borrowed funds not eligible include builder incentives or loans, realtor or mortgage broker incentives, or loans to the borrower that impact the property selling price. The first-time homebuyer incentive is not eligible with this program. To qualify for the first-time homebuyer incentive, the down payment must come from your own savings. The mortgage insurance premium is 0.5% higher when the down payment is borrowed. This raises the insurance premium from 4% to 4.5%. Mortgage insurance is paid by the borrower but added on top of the mortgage and is not a closing cost expense. An immediate family member is also permitted to act as a co-borrower. This person must be on title of the property but are not required to live in the property. The purpose of a co-borrower is to raise the combined income of the applicant, but the co-borrower's own debt load, income, and credit must also be taken into consideration. A co-borrower with low income, bad credit, or high debt load may not help the primary applicant. A co-borrower does not need to put down any portion of the down payment, but would be legally liable if the mortgage went into default. To give you an idea of how lenders qualify borrowers, they look at income, credit score, and your GDS and TDS ratio. A GDS ratio stands for Gross Debt Service Ratio. This is the maximum total amount of monthly mortgage payments, property taxes, 50% of condo fees, and heat that you are allowed to carry in relation to your monthly income. The maximum GDS allowed under the Borrowed Down Payment Program is 39%. To give you an example, if your income is $120,000 per year and your credit score is 680 or higher, you would be allowed to carry $3,900 per month in mortgage payments, property taxes, 50% of condo fees, and heat. The TDS ratio, or Total Debt Service Ratio, takes into consideration all of the GDS expenses, but also adds any other monthly debt obligations such as loans and credit card minimums. Expenses such as food, fuel, cell phone bills, and public transportation are not taken into consideration. The maximum TDS allowed under the Borrowed Down Payment Program is 44%. Since GDS represents the maximum amount of property expenses that you can carry, we will work backwards to figure out how much debt the same person earning $120,000 per year can carry without affecting the size of the mortgage. This means our borrower can have up to $500 per month in non-household debt obligations without impacting the maximum mortgage affordability. The maximum amount of mortgage payments, property taxes, heat, and debt obligations this applicant can carry is $4,400 per month, but their GDS must not exceed 39% or $3,900 in this borrower's case. Since $4,400 is the maximum debt load including household expenses, if our applicant has more personal debt, they will have to reduce the size of their household carrying costs until both the household and personal debt are under $4,400 per month. To complicate things, in January 2018, the federal government introduced a mortgage qualifying stress test. The mortgage payment in the ratio must now be calculated using a rate of 2% above what your actual mortgage rate is, or the Bank of Canada's qualifying rate, whichever is higher. Currently, the Bank of Canada's qualifying rate sits at 5.19% when 5-year mortgages are currently available at less than 2.99%. This higher qualifying rate makes the mortgage payments in the GDS and TDS ratio much higher and reduces your affordability. The qualifying rate is only used when calculating your GDS and TDS ratio. It does not actually impact your monthly mortgage payments. The mortgage qualifying calculator at whatcaniafford.ca takes into consideration the changing Bank of Canada qualifying rate and gives you an accurate estimate of your maximum affordability under the stress test. The minimum credit score of the Borrow Down Payment program for the mortgage insurers is 650. However, lenders often have higher credit requirements. For example, with TD Bank, credit scores between 650 and 679 will have a maximum of 35% GDS and 42% TDS. These lower debt service ratios can significantly reduce affordability, especially once you factor in the mortgage qualifying stress test. Generally, a credit score of 680 or higher will make qualifying much easier. Let's take a look at some examples where I try and push the maximum purchase price with the smallest down payment from savings. Our example borrower has a $105,000 a year income. This is a combined income if purchasing with a partner or with a co-borrower family member. They are a first-time homebuyer with a credit score over 680. They have no existing credit card or line of credit debt, no car loan, student loan, or any other kind of loan at the time of the application. Having monthly debt obligations such as car loans will substantially restrict your ability to borrow. Scenario 1. This borrower would be able to purchase a $500,000 condo with maintenance fees of $430 per month and property taxes of $3,000 per year. It is assumed heat is included in the maintenance fees. The minimum 5% down payment would equal $25,000. If this applicant can obtain a personal loan for 5 years at 6% interest, they would be able to borrow $22,500 at a monthly loan payment of $435. A first-time homebuyer purchasing a $500,000 condo in Toronto pays $4,475 in land transfer tax after the first-time homebuyer land transfer tax rebate, plus approximately $1,130 in legal fees. Outside of Toronto, the land transfer tax would only be $2,475. Assuming the property is being purchased in Toronto, the borrower would need approximately $30,605 for closing. If the borrower can obtain the loan for $22,500, this would lower the borrower's required savings to approximately $8,105, including closing costs. In this scenario, we push the 39% GDS as high as a household earning $105,000 could afford, and our TDS ratio is less than 44%. The maximum amount of money left for other debt obligations is $444.14. Since our borrower's monthly payment on the $22,500 loan was $435 per month, they would qualify. A simple way to estimate the maximum amount of non-mortgage debt that you can carry would be to multiply your income by 5%. This is how I estimated the maximum bank loan monthly payment. If you can obtain a lower interest rate on the loan, your payment would go down and you would then be able to borrow more. If you can obtain a longer term, the payment would also shrink, allowing you to increase the size of the loan. Conversely, higher interest rates and shorter repayment terms will lower how much you can borrow and still qualify. It is reasonable that a household earning $105,000 with a credit score of 680 with no debt should be able to qualify for a combined line of credit or personal loan of $22,500. Let's take a look at another scenario. Scenario 2. In this scenario, we'll use the exact same Toronto condo. In our previous case, we borrowed $22,500 as a bank loan at a monthly repayment of $435 per month. If that same $22,500 was borrowed on a line of credit or from credit cards, the insurer would calculate the minimum monthly payment at 3% of the outstanding $22,500 balance or at a cost of $675 per month. This would exceed the borrower's maximum TDS, so the borrower would not qualify. The maximum this borrower would be able to borrow from their line of credit or credit cards would be $14,500 if they wanted to purchase a $500,000 property. With closing cost of $30,605, less the borrowed down payment of $14,500, the applicant would have to have a minimum of $16,105 in savings. Closing costs such as land transfer tax and legal fees can also be borrowed but must be included in the debt calculation using a shorter 12-month repayment schedule. This creates higher monthly payments and reduces affordability. It is recommended that you borrow your down payment but have your closing costs and savings. In our first two scenarios, our borrower was limited to the amount they could borrow for the down payment because there was only a limited amount of room left for TDS after we pushed the maximum amount of mortgage we could get to 39% GDS. A TDS of 44% has to include both monthly debt obligations and the GDS. If we lower the carrying cost of the home, we can increase the amount available for monthly debt obligations. Let's take a look at our third and final scenario. Scenario 3. If we make the smallest down payment out of pocket a priority and are willing to lower the maximum purchase price, our borrower can purchase a $465,000 condo with $2,400 per year in property taxes and $430 a month in maintenance fees, including heat. The borrower would be able to borrow the full 5% down payment of $23,250 from a line of credit or credit card. To calculate this, we work backwards with the maximum amount of TDS that the borrower can carry with their income. Keep in mind, this is the mortgage payment calculated at the higher Bank of Canada qualifying rate, not the actual mortgage payment. A first-time homebuyer purchasing a $465,000 condo in Toronto pays $3,075 in land transfer tax after the first-time homebuyer's land transfer tax rebate, plus approximately $1,130 in legal fees. Since they can borrow the full down payment, this borrower only needs to have $4,205 of closing costs in savings to purchase this property. Outside of Toronto, the land transfer tax for this first-time homebuyer is $1,775. With the legal fees of approximately $1,130, this borrower's closing costs from savings drops to $2,305. When borrowing for your down payment, the higher preference would be towards whichever instrument offers the lowest interest rate. Typically, the lowest rate is a bank loan, followed by an unsecured line of credit, followed by a credit card. To borrow large amounts of cash from your credit card, you may need to request a convenience check from your credit card company. Not all credit card companies offer this, but many do. You can make the check out to yourself and cash it to your own bank account. Although the mortgage insurer calculates the repayment of the line of credit at 3%, many lenders like CIBC only require a minimum monthly repayment of 2% on the outstanding balance. Royal Bank's line of credit only requires a minimum payment at interest only. Both of these will help lower your minimum monthly obligation of the debt, but significantly draws out how long the debt takes to be paid off. The purpose of this video is to show an example of the maximum amount that can be borrowed. Even though it is possible to qualify while borrowing all the money for your home, I recommend having as much as possible saved towards the 5% down payment. Owning a home, especially your first home, is expensive. Having no access to emergency capital can put you in financial trouble, and being maxed out on your credit cards can put you in a debt cycle that can take a long time to get ahead of. Thanks for watching. Have a great day.